by feet. That seems crazy. There's got to be some partition or something that's taking up all the space. So hello, can anybody actually hear me? Hello, 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 hello. All right, anyway, so let's see if we can do something here. So this morning I was talking about the dollar, and you cannot generally, money is in a state of essentially equilibrium. In other words, it might fluctuate up and down a little bit and so on and so forth, but there's no major fluctuations in currencies. That's not the case lately. And look, part of the reason for that is because every country, including us, especially us, is massively in debt. That there are rival forms of currency, even though they're bullshit, but like when a currency starts losing faith, like all fiat currencies are, then other currencies like Bitcoin will rise up to attempt to take their place. There's unbelievable amounts of money to be made in getting people to accept these idiot currencies, because essentially you're setting yourself up as the government. You're getting all the perks of being government without having to have an army. You get all the money. You issue the currency, but you don't have to back it up with anything. Like, you don't have to perform any services. That's one thing. You don't have to police. You don't have to clean up the waste. There's things government does that are important, and when their currencies start failing, when people lose faith in government currencies, they go to other currencies. But what's the end game here? We all use Bitcoin, and what happens to America? What happens to a country when they can no longer collect tax revenues? Are they going to count on everybody volunteering? I mean, if you think there's income inequality now. So what we're seeing as a result of that is, and really not to overemphasize Bitcoin, which is $2 trillion. It's not just Bitcoin, but all crypto total is $2 trillion, and Bitcoin's about half of that, I imagine. And that's a lot. $1 trillion is a lot. It means 1,000 people could be billionaires in Bitcoin. It's not nothing. So, you see all this money being put into a fake currency, and it damages the real currencies. And also, the money goes into gold, the money goes into silver, the money goes into precious metals. People are looking for alternatives. They don't want to keep their money in dollars. And if you don't keep your money in dollars, that decreases the liquidity of the dollar, and so on and so forth. Now, in reality, people do want to keep their money in dollars. That's why we have this. We went from below 100 to 105 in basically 2 months. That's a major move, and there is very little resistance on the way up. So we'll see if it pops over 105, and as soon as you see another point over 105, as soon as we hit 106, we're probably on the way to 110, and that's devastating for other currencies. So meanwhile, Japan hits their own spot here. So yesterday they had a little panic, and they talked about supporting the yen. And China's in the same position with their currency, and all of Asia. Look at all of Asia, 97 to 91 this year. So that's what, 6% or so of their total currencies. Even the euro from 113 to 107 is nasty. That's a good 5% there too for the euro. So, you know, all currency is bullshit. It's a dollar is only worth a dollar because I know that I get paid $50 an hour, let's say. Okay. So I know I make $50 an hour. How much is that? 42,000 a week. Yeah. Okay. 2,000 a week. All right. So let's say I make $50 an hour, $2,000 a week. I know what an hour of my time is worth. It's worth $50. I know what $50 is worth. $50 is worth $50 is worth about what I buy at the grocery store when I'm in a quick trip, not a big trip, but when you're just filling out some stuff in the top basket. So $50 is worth that. $50 is worth one dinner, right? $50 is worth a tank of gas, not a full tank, but from some point. So $50 a tank of gas, but that's the point though. It's no longer worth a tank of gas. This is where it all starts breaking down, right? Because $50 is now half a tank of gas. And $50 is no longer worth a dinner. But I'm still getting paid $50. That's bullshit. So now I'm working more than an hour to get my dinner. Now I'm working more than an hour to get a tank of gas. I'm working more than an hour to get my grocery. That's when it starts falling apart, because the whole point of a fiat currency is you're supposed to use it as a universal means of exchange. There's an expectation and an understanding that your labor is worth X, and X will buy you X, or X will buy you Y in goods and services. But when all the prices start changing and it's complete chaos, then the system starts breaking down, because now this paper doesn't mean anything. It's like I used to be able to count on this paper. This money was going to give me $50 of this money was going to be a trade for my labor, and a trade for my labor is now this. Now, see, if you had a barter economy, this wouldn't happen. You wouldn't have inflation. Inflation is caused by fake money, by relying by having fake money as a basis of our exchange. That's what the barter system, that's what breaks down the economy. You don't have runaway inflation in a barter economy. It's like if I, if I do an hour's worth of work for you, and that used to be worth 2 fish, and you would give me 2 fish, then you should still give me 2 fish. What's the difference? Still doing an hour's worth of work, you're still giving me 2 fish, right? And I go to or the doctor comes over and he pays me a visit, and he fixes me up, and I tell him how to invest. It's a barter system. But the thing is, in a barter system, you don't get to go changing your prices. There's an anchor to a barter system where you've always traded your service for this and this service for that, and that gives you to the other person. And the money is just a way to make that more efficient, but it's not more efficient when you can't trust the money. And you can't trust the money when the governments that issue it feel free to print more whenever they want to, and to just borrow it as if it's nothing. Nobody in their right mind would lend America money. Nobody in their right mind would lend Japan money. What the hell? That is a failing economy. So we use this fiat currency system to prop up all these bullshit economies. And then what's happening now for the second time, this was in October, not that, it was a year ago, last October, a lot of countries intervened, and they tried to knock down the dollar. And how did they try to knock down the dollar? They tried to knock down the dollar by pushing more dollars out into circulation. So that's how they do it. In other words, they would basically exchange and get more. They purposely create a lower demand for dollars by pushing dollars into circulation and creating a greater demand for their currency by taking it out of circulation. And that's how they strengthen their currency and weaken the dollar. We didn't care because the dollar was pretty damn strong at the time, and it was hurting everybody, so we just let it happen. Sometimes you get into currency wars where one country starts attacking another country's currency, trying to strengthen their own or weaken their own, whatever they're trying to do. And the other country might respond and say, I'm not putting up with that bullshit. I'm gonna sell your currency instead. And so it's a very complicated thing, but it's important. That's why I wrote it up today. It's important to understand because you got to see what's happening here. We're about to have a currency war. We haven't had a currency war in a long, long time. And the problem is that you've got these countries that have massive debt loads, no possibility of ever paying them back. And they all want to try to prop up their currencies and make them seem stronger. But it's fake. The propping up is fake. Okay, this is reality for Japan. 67. I remember when it was like 120. I went to Japan. Last time I went to Japan was a while ago. When the hell was I in Japan? Like 10 years ago. So the last time I was in Japan, it was about 120. This is like half of that. And they've been living on this for a long, long time. And again, like I said, it's kind of a barter system. Internally in your own country, it's very much of a barter system put on paper. But when you have to trade with other countries, they didn't agree to your barter system. You know, in another country, the doctor might want I'm sorry, the doctor might want more than an hour's worth of my time, or the fish guy might give me 3 fish instead of 2 fish. Who knows what the system is? You know, other countries have their own systems and have decided on their own amount of their own value of certain payments. But the bottom line is the currency, that's the problem with fiat currency. It is notional. It's not a hard fact. It's not a scientific method for determining the value of a currency. It's based on sentiment. It's based on availability. It's based on the overall workings of the country. Like Russia's a complete disaster now because they're spending a fortune on a war. And it's, you know, it's not investing dollars. You know, a war is not an investment. I mean, I guess unless they get the land permanently, if they permanently get the Ukraine, I guess it's an investment, right? They take over a huge amount of land and they get to tax it and farm it and do whatever. But if you lose a war, it's just a waste. Then you spent all that money on arms and equipment and so on and so forth. Most of it's burned up on the ground, and you've got nothing to show for it but debt. So, so keep your eye on this. And you know, frankly, it's the same way I say keep your eye on it as I did when we were talking about the Chinese real estate like a year ago. You know, so it takes a while for these things to play out, but this is now, it's hitting to something now. I can see it. And it was because the Japanese guys said they were going to support the currency that I suddenly said, wow, we got to start paying attention to this now. It's getting serious. Now let's talk about this. This is important. So we have our $700 a month portfolio, and people are asking me like, you know, is it too late? Did I miss it? Blah blah blah. I'm like, how did you miss it? If we're trying to make $1 million and we're up to $13,000, so it really is not a significant miss if you're just getting started. You can really catch up. And not many of our trades are up so much that you can't get into them. Who's up the most? GoPro is up $500. That's it. It's not, none of them are really up that much, but as a group, they've all been doing very, very well. But this set of trades right here, okay, how much are we going to make if it all goes well? 160. Then this one is, oh, that's no way to tell. Shit. $7.10. No, that'll be too much math. We're not going to get there. I can already see it's not going to work. So this is 1,500. It's currently valued at $700. So it's 800 to go there. It could be done. All right, well, let's see if we can manage this with a calculator. All right. Let's just show you. All right. Oh, that's going to be so annoying. Wait a minute. There we go. Okay, so how much more money can we make on this one? We can make 160 bucks. This one we can make $800. This is a $1,500 spread, and it's currently 5. So this is 1,000. GoPro is a $1,000 spread, and it's net. Ooh, are you kidding? How could that be? It's a $2 spread times 5 is a $1,000 spread, and currently it's already like 800 bucks. No, it's already 900 bucks. We should take that off. What are we doing? See, and this is why you need to go through these once in a while, right? Because this is already net 900 bucks, or a little bit less than 900 bucks, but it can only be $1,000 if it goes perfectly, and it's at 364. There's no upside to us keeping this trade till 2025. We can only make another 100 bucks. We're tying up 900 bucks. So we have $900 invested to make 1,000. We started off with a $400 spread. Oh, and that's what I said. That was when I said GoPro, we made 500 bucks. That's it. 500 bucks is plenty. We're done with this trade. But either way, so conceptually, we could make $200 more on GoPro, but we're going to kill it. Sophie is, oh, that's a biggie, $2,500 spread. And it's currently 600 bucks. So let's call that $1,900. And SunPower is a $2,500 spread that is currently $1,400. Let's say that's $1,100 to gain. SQQ is a $60,000 spread, and it is, well, that's our protection though. We're not going to count this as a thing. And it's currently nothing. It's a $60,000 spread that you can currently buy for 1,000 bucks. And it's in the money. So that's a pretty good hedge. All right, moving on. Trox is a 5 times 5, 25, $2,500 spread for 1,000. So that's plus 15. And UNG is a 3 times $900 spread, and it's currently at what is that? That's 7,350, let's say. So that means there's 550 more upside. IVZ is a, what is that? What on earth do we do here? Oh, I see. So it's not really a spread. We have, oh, it's weird. And it's hard to say what this is. We have 5 longs. We have 3 shorts. We're going to roll these eventually. Let's say it goes to 20. Let's say it's at 20. So we'll call this a $1,500 spread. It's currently net 5. So there's 1,000 to gain. You see, because what I'm saying is it currently looks weird, but eventually we're going to roll these 15s to a higher and higher and higher strike. And I'm sure we're going to get $1,000 out of it. So that should be in good shape. Future fuel. This is a $400. And it should be 1,000. That's weird. Oh, because it's a put. Oh, we didn't even sell calls. So if we make it to $10, we'll have 1,000, and that's our projection. And it's currently $400. So that's $600. Not only that though, but if it doesn't go higher, then we'll sell some calls, and we're still going to get our $600. And the last one is Nokia, which is a 3-5 spread. So that's $2,000. And it's currently 1,000 minus 100, about 900. So what I say was a $2,000 spread? Yeah, 2,000 is a plus 11, plus 1100. All right, so there you go. So there's $9,900 to be gained on 13,000, by the way, over the next 16 months. So that's my gain divided by 13,460. 73%. So over the next 12 months, if all goes perfectly, and it never does, we're going to make 73% on this portfolio. So you could start now and make 73%. And we'll be on track to get to our $1 million goal. Frankly, at this rate, if we keep hitting 40%, we'll be on track. It'll only take us about 10 years to get to $1 million. I know that seems crazy, because we're only putting in $700 a month, but that's what compounding does. I think I've shown you guys that for sure, but let's take a look. Yeah, go away. Compound rate calculator. And I like Money Chimp. That's my favorite. Site can't be reached. How is that possible? All right, so we start out with, all right, you know what? Let's do it from now. We start out with 13,000 blah, blah, blah dollars. Wait, where was that? So we started out with $13,466. 13466. We're adding $8,400 a year, 10 years, 40%. $1.2 million. Isn't that insane? This is all you have to do. And again, 40% is not usual at all, but the trades we have will make 70%. So we have year one behind us, and that made 40%. And now year two, we're hoping to make another 40%. And if we can string together 10 consecutive years of 40%, we will have $1 million. And that will be from investing. You know, compound interest is an amazing thing. We will, because the money just keeps adding on to itself, but we're investing $8,400 a year times 10 years, $84,000. We're going to invest $84,000 to make $1.2 million. And here's the thing about this portfolio. Whoops. And this is why I always repeat this in the thing, because it's like, here it is. Here's every single thing we've done for 12 months. This is how we built this portfolio that's currently up 48%. We're not using margin. We're not taking any kind of big risks in anything. Being very cautious, but what do? We we take a Barclays spread, and here's our leverage. Instead of doing a 5-5, we do a 5-3. That's our gamble, is we leave 2 open calls. You know, here's a 5-5 on Ford, but our target is $15. It's not a high target. GoPro, same thing, 3-5, fully covered spread. We only wanted to get to 5. You know, here's SoFi, and they're at well, this is our second swipe at SoFi actually, because we already had a successful trade on them. Here's SunPower, which is down in the dumps for no particularly good reason, and we're in the money by 229 here. You know, and the spread is only net $1,400. This one, like I said, is ridiculous for a hedge. I can't believe it. It's so crazy how cheap it is. 24 minus 14, obviously, it's $1,000 spread, $1,000 cost, but the spread is 4 times 15 times 400 times 15 is $60,000, and no, it's not 60,000, 6,000, isn't it? Whatever. Stupid. Hang on. 400 times 15, 6,000. It's not 60,000. That's an important difference. Anyway, 6,000 is fine for this portfolio. So it's $6,000 worth of protection for $1,000, and you're 277 in the money on the 15 calls. So 277 times 4 is more than $1,000. So you're buying it. You know, you get all the upside from this hedge. And the risk is, of course, losing the $1,000. But if you lose $1,000 and we make what we plan, which is 70% of this, then that's not going to really matter much, is it? Trox is a fully covered spread, and it's a couple of bucks in the money already. UNG is a fully covered spread that's actually, you know, most of the way to the money. IVZ, partially covered spread. So that one's aggressive that we're on. It's working so far. And I know when you look at this thing, it's like, so these are such boring plays. But I have no right to take a chance in a portfolio like this. This is the whole point of this is to pick very, very high percentage plays that win and win and win and win. You know, we've turned over a lot of trades in this portfolio. Have already turned over in less than a year, and that's because we picked them at the right time. The ones that are still here hasn't been the right time yet. That's all. Oh, other than with the GoPro, yeah, the GoPro, which we have to take off. But that's how it works. So in other words, something matures like GoPro, and it's $900. The most we can make is $1,000. So why would we stay in the trade? Now we've got $900 tied up to make $100 in 16 months. That doesn't make any sense. We know we can do better than that. That's not even, that's 10%. So we're not looking to do that. But these are nice conservative trades that don't use any margin. And they just win and win and win and win. Because they're good, sensible picks that we pick each time. And you know, we try to get it right for the value. And some things take off right when we think they will, and some things take a while. But either way, it's like it's going to come back eventually. You know, future fuel hourly is down. I mean, it's funny. You can buy the spread for $400, right? 300, yeah, $417 for future fuel, and that's with the short put. So you might end up with another 100, and then we could sell the calls. Oh, I can't look at Thinkorswim. We could sell the calls eventually for a couple of bucks and end up with $200 net on the stock. And keep in mind the stock is at 712. So I'm paying $400 and the stock's at 712 now. That's 75% right there. You know, that's what we've got to look at. You know, you've got to learn how to make these conservative, nice plays in your portfolio. And they, of course, they're boring. They're supposed to be boring. But when you make 40% in a year in boring plays, then you can become a wealthy person. And that's the exciting part. Don't worry about being excited day to day by your portfolio. Worry about being excited day to day by your life. This is how you make money. Slow and steady does win the race in this case. And what do we add? I don't even know what we added today. Who did I pick for an end? Why isn't AT&T in this thing? Oh, Walgreens. We picked up Walgreens. Why? Walgreens went flying down. Just because they don't have a CEO. The company's not going to explode because they don't have a CEO. They have a CEO. I mean, somebody obviously internally got temporarily promoted to CEO. But, you know, again, that's the idiocy of believing a CEO is like makes or breaks a company. And honestly, you could say that's true of an exceptionally well-run company. You know, like Apple, if Tim Cook leaves, I'd be concerned. Who's going to replace Tim Cook? And Tim Cook is a less interesting version of Steve Jobs, I would say. I mean, Steve Jobs was a visionary, creative, driving force, but he sucked at running the company. Tim Cook was great at running the company. That's what he did for Steve Jobs. So once you got those two guys together, Apple became a money machine. Now, Steve Jobs died. Tim Cook is still keeping Apple as a money machine, but where's the next step of innovation? That's the problem. Tim Cook is not an innovative, creative guy. Doesn't have the vision to go to the next stage. And their top design guy, Ivy, he left because, you know, he doesn't like the fact that Apple's being run more like a company trying to make money now than a company that, you know, wants to innovate at all costs. And that's what Steve Jobs used to do. He used to approve all sorts of insane expenses to drive the company forward, to innovate. And was he right? Yeah, you know, you can be right and wrong at the same time. You're right and you're wrong, because first of all, Steve Jobs got fired from Apple for totally screwing them over as far as financially at one point. Then they brought him back when they realized that they couldn't function without him. And then they finally figured out that, like, giving him an operations guy like Tim Cook, who doesn't threaten him at all creatively. See, this is the problem, because you know, for Steve Jobs, Tim Cook was a guy who would just like run the company and have absolutely no ideas. He could whatever Steve Jobs wanted to get done. You know, Tim Cook would just execute it and figure out how to cut the costs and make money on it. You know, and that was a great combination. But you know, will Apple have the next great innovation is the question. That's the problem with these kind of companies. You know, and Apple's a great company, and they can live a very long time just refining all the crap they already have. I mean, they've got you know, their phone is like a Swiss Army knife, right? Those had 100-year run, or whatever, or having who knows how long a Swiss Army knife was a Swiss Army knife. But you know, Swiss Army knives are ubiquitous. Everybody had one at one point, and everybody has an iPhone. What would the next thing come along be? I don't know. But will it be developed by Apple? That's the question. Swiss Army knife didn't develop the iPhone. You know, they just keep making Swiss Army knives until nobody wants them anymore. So you have to think about what your companies do. But Walgreens, I mean, this is just stupid. It really is. I mean, they sell drugs. Everybody has drugs. Everybody buys drugs. They're not, and you think that they're losing money. You would think, you say, oh my God, look at this company. What's going on with these guys? What's going on with Walgreens is 2245 is $19 billion. They make $3.4 billion a year. 3.4. They've done better. They've done much better in the past, whatever. But in the past, they were valued at $40. Now they're being valued at not $40, 40 billion. Now they're being valued at 19.6 billion. So you take 19.6 19, whoops. So 19.6 billion, and you divide that by 3,400, and that is a PE of 5.76. That's just stupid. They do you gotta understand, they do 140 billion in sales. 140 billion in sales. If they raise their prices 1%, they will add 50% to the bottom line. All right, so you just have to give the time to cycle through and for them to adjust their product mix and adjust the prices and so on and so forth. And they've got tons of room to improve themselves. And they're trying to do it without raising prices. That's been a mistake. It's been a mistake I've been complaining about for a couple of years. They got to wake up and just deal with the price. Nobody's going to Walgreens to get the cheapest possible prices on things. I mean, I know if you go there, you can buy candy. Everything's 2 for 1. It's like so weird. Go to 7-Eleven, it's like it's more than twice as much if you buy candy at 7-Eleven than if you buy it at Walgreens. I don't really know what they sell a lot of, frankly. I mean, it's very odd to me. They make you walk, like they make you wind through the whole store to get to the pharmacy department in the back, and then while you're there, they make you wait. So you're like sitting there browsing all these things that I don't know. I'm not sure who actually picks them up, but it seems I don't understand who actually goes to Walgreens to buy their frozen foods and things like that. But whatever, the point is, it's not like they're idiots because they got 138 billion in sales, and it was lower than that before COVID. So their sales are up, but their margins are down. Okay, fine. That doesn't mean they're going to go bankrupt. They've got $10 billion in debt. They definitely have a working capital issue. They don't have enough working capital, but they do have cash and they're fine. They've got lines of credit and so on and so forth. It's just too stupid because 138 billion. I mean, look at let's say Target. I imagine is that much. No, that's not Target. TGT. Oh, so good. Target, 107 billion in sales, the same profit as Walgreens. They have a better margin. We'll give them that. Target's got 13 billion in debt. Target has poor cash flow. Poor working capital. So Target is essentially the same company as Walgreens, yet they have a $57 billion valuation. What's the difference between Target and Walgreens? Target has is a retailer with a lot of stuff. You go to the store and you buy things, just like Walgreens. Target's got lots of locations. Walgreens has lots of locations. Target is a well-known brand. Walgreens is a well-known brand. Okay, Target has $107 billion in sales. Walgreens has $140 billion in sales. Target makes $3.5 billion. Walgreens makes $3.5 billion. Okay, Target has slightly more debt than Walgreens, probably a little bit better on the working capital situation. All right, it's ridiculous to value Walgreens at such a low price. And look, the crux of fundamental investing is that you have to understand that eventually somebody's going to look at something like this and be like, well, if I put $123 into Target, I'm going to get this return on money. It's 14, so 1.6. You're going to get like wait a minute. How does that work? You're getting 14 times earnings. Yeah, then you're getting 6%. Basically, you're getting like 6% back on your money. And if you put your money in Walgreens, you're getting 20% back on your money every year. At some point, that matters. And it doesn't seem to, because most traders don't buy based on the fundamentals. They don't. They trade on things like, oh my God, they don't have a CEO, they're going to die. Okay? What company can you name that the CEO left and the company stopped doing business and folded? You know, I don't mean scandal. I mean just a normal company where the CEO leaves, and it's not like Walgreens won't find another CEO who wants to take $2 or $3 million or $5 million to run the company. I'm pretty sure they will. And I've been saying they need to get these guys from England who know what they're doing, the Boots people. Boots Pharmacy, UK. Because, well, I can't see really. Anyway, so Boots are like super nice. I mean, they look like that, and they're by far they sell half of the beauty products in England. I mean, that's pretty amazing. That their store is all about you know, it's more like oh, what's that thing? Ulta. It's more like an Ulta when you walk into a Boots. It's really all about the beauty and skincare and creams and all that kind of crap. And you know, they happen to have the pharmacy in the store. Here's a little pharmacy. Menopause friendly. That's weird. But anyway, they have, I mean, look at this. People lined up. That's crazy. But they are, I mean, Boots is a super operation. And when Walgreens merged with Boots, I thought that they would, you know, they were buying Boots to be more like Boots, not to be more like Walgreens, not to make Boots more like Walgreens. And they haven't contaminated Boots. But see how it's like, you know, it's not that different than Walgreens, but it's just a little bit nicer. See, order and collect pharmacy, hearing care, baby care, photos, gifts, opticians. You know, it's very different than our Walgreens are. But Boots is like, it's a super brand in Europe. It's like totally known for being the best. And they do incredible business. And we should be more like that instead of the haphazard bullshit that Walgreens has. See, that's their food and drink, is this little area over here. It's not like half the store. I mean, it's not, I mean, look, a pharmacy is a pharmacy, right? But it's they just do a better job than Walgreens does. So anyway, but certainly nothing to be thrown away. And this is just silly at this point. So we got $1,000 of buying power left. We add $700 next month. We'll have $1,700. We buy some more stuff. But that's all we do every single month. This is all we do. And we build up these positions one by one by one. And as boring as it is with these stupid little returns, and you can see it here, we got 76% to make on the $13,000. 76% to make in the next 16 months. And obviously we'll buy more things and make more than that. But it's just step by step, inch by inch. We make a few hundred here and a few hundred there and a few hundred there, and it adds up. That's how you build a portfolio. All right, now let's see what the Fed has to say. Beige book. How's everybody doing out there? Good. David says, I would check the current prices on GoPro. I can't look at Thinkorswim, but I'm showing $100 loss. Did something happen to them in the last day or so? Did they drop significantly? That'd be a shame. GoPro. Ooh, that did change a lot, didn't it? Well, that's a shame. All right, so we just hang on to it, and then well, not a $40 loss here. What happened? That's interesting. It's one of those things that have been drastically repriced. This is just from yesterday too. GoPro 223 and 45, and now it is 115 and 40. Wow, that dropped considerably. So our long GoPros got smacked down. That's interesting. Oh well. But anyway, so when you did that, and again, this is why when you see something like that, you take advantage of it. And we didn't, I didn't even notice it when I was doing it yesterday. But yeah, that's, if you see something like that and you can take advantage of it, you absolutely should, because it's like, wait, why do we make so much money? And you say, well, if we can get it, then take it. So if it's not that, then we can't take it. Then it's no good to us. I don't know why it was that price in the morning, but that's the price it was showing for whatever reason. So no, we're not going to be making that change if it's not still available. Where were we? Fed, beige book. September 6th beige book. Okay, so remembering that there are 13 districts. This isn't 13 though. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. We lost a district. Contacts from most districts indicated economic growth was modest. So most and modest, not necessarily the great thing. So let's say most is 7 and modest is barely growing. So and then it depends if the other ones were up or down. That's what matters. Consumer spending on tourism was stronger than expected, surging during what most considered the last stage of pent-up demand for leisure travel from the pandemic era. But other retail spending continued to slow. That's dangerous. Other retail spending continued to slow. So we had a boost from tourism, and that for sure has an expiration date. Retail spending slowed, especially non-essential items. Some districts, like sneakers, right? We learned that. We learned that Foot Locker and Nike and everybody had a terrible, terrible time in the last quarter. People were just putting off purchases of things that they don't need to buy. Some districts highlighted reports suggesting consumers may have exhausted their savings, which we obviously have talked about a lot, and are relying more on borrowing to support their spending. New auto sales did expand in many districts, but context noted this had more to do with better availability of inventory rather than increased demand. Manufacturing contacts in several districts also noted supply chain delays improved, and they were better able to meet existing orders. New orders were stable or declined in most districts, and backlog shortened as demand for manufactured goods waned. That's not good. In other words, new orders were stable or declined. Backlogs shortened as demand waned. So it's not, the backlog isn't shortening really because the supply chain is improving. It's shortening because less people want stuff. One sector where supply did not become more available was single-family housing. Nearly all, this is interesting. Why are the builders not building homes? Nearly all, I think it's, That's where you have to start wondering if this is a really critical problem. I mean, people cannot afford 8% mortgages. People are just not buying, because if they could afford an 8% mortgage, the builders would be building. Nearly all districts reported the inventory of homes for sale remained constrained. Accordingly, new construction actively picked up for single-family housing, but multiple districts noted the construction of affordable housing units was increasingly challenged by higher financing costs and that's the other thing, rising insurance premiums. By the way, that's not it either. What about rising property taxes? I think everybody's seen that now, right? Because local governments who do your property taxes, they have to balance their budget, and they balance their budget by taxing your home. They don't get to kick the can down the road. They have to balance their budget every year. And so when costs go up for the town on the things that they do, they have to pass that along to you in higher taxes. And that's really making homes expensive also. Bankers from different districts had mixed experiences with growth in loan demand. Most indicated consumer loan balances rose. Some districts reported higher delinquencies on consumer credit lines. That's a terrible thing too. Agriculture conditions were somewhat mixed, but reports of drought and higher input costs were widespread. Energy activity was mostly unchanged in the final month of summer. That is not a good report. Labor markets. Job growth was subdued across the nation. Hiring slowed. Most districts indicated imbalances persisted in the labor market as the availability of skilled workers and the number of applicants remained constrained. Worker retention improved in several districts, but only in certain sectors such as manufacturing and transportation. Many contacts suggested the second half of the year will be different when describing wage growth. Now, what does that mean? Worker retention improved in several districts, but only in certain sectors, such as manufacturing and transportation. Many contacts, I mean, how cryptic can you be? Many contacts suggested the second half of the year will be different. Growth in labor cost pressures was elevated in most districts, often exceeding expectations during the first half of the year. But nearly all districts indicated businesses renewed their previously unfulfilled expectations that wage growth will slow in the near term. So with no evidence at all and no basis for making this assertion, these guys, the business owners, are continuing to say that the wage pressures aren't going to last, even though they can't find workers to fill their jobs, and even though that they're currently seeing much more wage pressure than they anticipated in the first half of the year. It's a very dangerous miscalculation. If you're wrong about something as important as your labor costs for the half of the year, that's margin pressure right there. That's going to be a big source of margin pressure on businesses. And apparently they're sticking to this narrative. How are you going to reduce labor costs if there's still 8.5 million more jobs than there are people to fill them? How are you going to reduce your labor costs? What's the plan in the next half of the year? You know, the Fed's plan was to induce a mild recession. That hasn't actually happened yet. In fact, the growth is crazy. We have grown pretty fast, and that's going to put even more pressure on wages. This is a big problem that people aren't dealing with. Price growth slowed overall, and we talked about that being because the dollar's up 5%. So yeah, of course, price growth slowed overall if the dollar is up 5%. Decelerating faster in manufacturing and consumer goods sectors. However, several districts highlighted sharp increases in property insurance costs during the past few months. Contacts in several districts indicated input price growth slowed less than selling prices. As businesses struggled to pass along cost pressures. As a result, profit margins fell in several districts. So, you know, this is what we've got. We've got and again, we've talked about this before. Inflation is a push-pull sort of situation. It goes back and forth until you get to an equilibrium. But it takes a long time because people demand. Okay, first prices go up. Something happens like COVID, and we had the supply chain disruptions and so on and so forth. So something happens like COVID, prices go up. Fine. But the workers then have to pay those prices. The workers become strained, as they are right now, and run out of credit and have no choice because it's not, people are not comfortable, especially these days, because it used to be, I used to quit if I didn't get a 10% raise. I would quit the job if they didn't give me a 10% raise at the end of the year. That was expected when I was 20 years old. In like the 80s. If you didn't get a 10% raise, why would you keep working for these people? Nowadays, people are so used to not getting raises that they don't even have the skill set to ask. So it takes a lot for people to ask for raises. But what happens is you push people to the point where there's no choice left, is there? You can't afford to put your kids in a daycare school. You can't afford to buy the food you used to buy. You can't afford to pay your electric bill. You can't afford to pay your cable bill. Something's got to give. And eventually people say, hey, maybe I should get more money at work. That would help. So that becomes a push issue from the wage level. So first prices go up, forcing the workers to ask for more money. The workers ask for more money. Now that's another price that went up for the company. The company might raise prices again. That's going to eventually kick back to the workers who are going to ask for a raise again. Takes a while for that cycle to stop. That's how you have what they call a spiral, a wage inflation spiral. We're nowhere near the end of this stuff, and everybody pretends it's over. It's insane. All right, Boston says business activity spread modestly on new car inventories normalized further, but used cars remain scarce. Home sales fell further, resulting in a disappointing spring and summer season. We've seen that everywhere. Concerning the outlook, fewer contacts mentioned a recession as a looming risk, and pricing pressures are expected to ease. Regional economic activity held steady through the summer. Labor market conditions remained solid with steady wage growth. Consumer spending grew steadily while manufacturing activity declined. Home sales remained constrained due to low inventory and rising rates. Inflationary pressures picked up slightly after easing much. Philadelphia. Business declined slightly. Manufacturers indicated an uptick in August. Consumer spending declined overall, as did non-manufacturing activity. Labor availability improved further, and employment edged up once more. Wage growth and inflation continued to subside. Sentiment was somewhat divided, but expectations were more positive. Cleveland, economic activity is generally flat. Conditions shifted notably. Consumer spending demand for goods softened. See, there's a lot of softening on the consumer side. Freight activity stabilized. Non-residential construction increased. Contacts expected similar economic to persist. Richmond, the regional activity grew steady. Consumer spending on retail and food, as well as travel, picked up. Manufacturers noted a decrease in demand. A lot of problems in manufacturing, right? Every place has manufacturing issues. Transportation volumes remained steady across freight modes. Residential real estate was constrained by limited inventory. Residential real estate was constrained. Yep, commercial real estate activity and lending declined. Employment increased moderately, and price growth eased slightly. Economic activity grew modestly. Labor markets improved. Wage pressures eased. Non-labor costs moderated on net. Retail sales were robust. Good for Atlanta. New auto sales were strong. Wow. Domestic leisure travel slowed while international business travel rose. Housing demand was durable. Transportation activity slowed. Energy demand was strong. Agricultural conditions were mixed. Sounds like we should all move to Atlanta. Chicago, economic activity increased slightly. Employment increased moderately. Business and consumer spending increased slightly. Construction and real estate was flat. Non-business saw a little change in activity. Manufacturing decreased slightly. Prices and wages rose moderately. Financial conditions tightened moderately. Expectations for farm incomes were little changed. St. Louis, see, Chicago's weird. They have like big city problems and rural problems in Chicago. St. Louis, economic conditions remained unchanged from our previous report. Employers reported continued tight labor, easing wage growth. Businesses struggled to pass on prices. This is where we get into trouble, though. This is where you're going to see margin pressure next quarter. In price sensitivity, weaker demand for high-end goods. Minneapolis, economic activity crept up on balance. Employment grew slightly. Hiring activity healthy. Wage pressures were flat. Job seekers prioritized work-life balance. Prices increased moderately. Firms were finding it harder to pass on higher costs. Consumer spending rose. Auto sales benefited from improved inventory. Manufacturing real estate activity fell. Damn, manufacturing. Farm conditions weakened. Okay. This is also, when you say, you see when wages are flat, this is an interesting thing. Wages are flat, but job seekers prioritize work-life balance. In other words, how many days do you want me to be in the office is now a question that you ask your employer. You know, and they say every day, and people go, no. So people don't want to be at work 5 days a week. People want to be at work 3 days a week, preferably 2 days a week, but you know, 3 you can probably get out of most people. There's various reports saying whether or not that's more or less productive. But when you see this work-life balance, it's not wages. It's not a direct cost to the person who's employing people, but it is a net cost because they're not getting the same overall productivity out of the worker. Or if that's the case, we don't really have the evidence for it. But you have to think that there's a certain percentage of people who are negotiating these work-life balances because their life is more important than their work, and that's a big change for companies, because in American companies, your work is supposed to be your life. And this can all lead to a downturn in productivity. Economic activity across the district was stable. Manufacturing production, sales, services improved. Greater ability to meet orders. Delays along supply chains were resolved. That's good. Job growth remained flat, but wage growth continued to exceed norms and business expectations. Contacts renewed expectations for slower wage growth ahead. Prices grew at a moderate pace. Dallas also should be a booming place. Modest expansion continued. Activity mixed across sectors. Solid growth in non-financial services, while retail sales were flat. And activity in manufacturing, energy, and financial. Wow, not a good report from Dallas at all. Employment growth picked up slightly overall, and wage growth remained high. Price pressures remained elevated in the services sector. Outlooks were fairly stable, though uncertainty persists. I am surprised because Dallas should have been benefiting from the energy boom. San Francisco, supposedly a disaster if you listen to any conservative media. Let's see what it says. Economic activity strengthened slightly. Labor availability improved. Wage pressures softened further. Price increases persisted, albeit at a slower pace. Retail sales rose slightly. On balance, manufacturing activity was stable. This does not sound like the San Francisco I'm reading about. Lending activity moderated in recent weeks. Local communities observed increase in demand for support services, particularly in areas impacted by wildfires and severe weather in Hawaii and California. Oh, wow, they cover Hawaii? Okay. So that's interesting, because that doesn't really sound like the crime-ridden disaster that's falling apart, right? Anyway, okay, so then they get into all the big details. So on the whole, not terrible, but you can see what's happening is the consumers are running out of steam, and the margins are tightening. They can't pass the costs along to the consumers. They're trying to cut costs internally. That's bad, though. You know, when you can't pass the cost to the consumers, but that's because they don't want to give the workers raises. If your main goal is not to give the workers raises, you shouldn't be surprised that your customers can't afford to buy stuff anymore. I don't know why this eludes people. But anyway, so that's where we are. Not an awful report, but certainly it indicates that there's margin pressures, and we're only at a certain point in the cycle. There's no there's not going to be an easy escape from this thing, I think. Let's see. TZ says FF is not 712 as you mentioned, but 662. Where was FF? Oh, it was 712 then. Yes. I don't make that up. That's the number that's on the chart as of the close. I guess it was as of Friday's close, because I did this first thing in the morning. So yeah, I apologize that the price of FF changed between Friday and Tuesday. Ooh, look at that. Ooh. Did not have a good couple of days, huh? But yeah, so that's where it is now. But see that? That's 712. So before the open, it was at 712. Now it's 662. That's a pretty big drop. What is going on with these guys? I like this company. I would buy more. See, we can't afford, see, in this portfolio, we can't really afford to chase things and buy more. It's difficult. This put is going to be hurting us a lot because it's a short $10 put, I think. But you know, the short $10 put that we sold for 210 is a 690 purchase. It's not a 690, 790 purchase. So it's not terrible. And we can roll it, and we will roll it. Oh, this is only February too. Oh, this is very short term. So we will just adjust this as it goes along. And like I said, we can always sell the call. I can't tell you what call we'll sell because I can't bring up Thinkorswim. But anyway, so the problem with this kind of portfolio is I can't make an adjustment based on we can't quit, we have to conserve our cash. So we can't really use it unless there's a clear and definite reason that we want to take advantage of something. So, honestly, this thing is down 246 and 130, which is a lot. It's 360, 370, 375 basically. So it's down 375. Not ideal, but like I said, we could sell a short call and cover it, and then buy 100 more shares if we want, and lower our basis considerably. And that's probably what we're going to do. But there's no sense in doing anything right now until the new calls come out, until we have like June or July calls at least. I don't want to sell more February calls. I want to sell longer term calls that have a bigger premium that we can bite into. But we'll see. I said, like, the point of this thing is to learn how to manage these things, and we will adjust it over time. But honestly, there's no pressure to do it. We'll do it when the time is right to do it. That's when we're going to make these adjustments. So anyway, all right. I can see that's the end of my voice, so we'll leave it at that. What was I going to say? Oh yeah, so very much watch the currency stuff. That's going to be a big deal for the next few days. Not the next few days, for the next month, basically. So September is going to have a lot of nonsense with currencies, and now that earnings have run their course for the most part, we're going to be very focused on the economic news during the month, and then the Fed has a meeting on the 12th or something like that. It seemed like a long way away, but it's not now. Oh, 20th. Sorry. So the 20th is when we're going to hear from the Fed. So we have 3 more meetings left for the year, and I think they've got another raise at least in them. So we'll see what happens, whether they do it. I see, the thing to me is if they do it, they're not going to do this. They're not going to raise it right before the holidays. That's out. So they can't do it here. And if you can't do it there and you don't do it here, then you have to do it here, obviously. And I'm not sure. I mean, I'd say given the market is in a good place right now and they don't know 6 weeks from now if it's still going to be in a good place, and they feel the need to tighten because inflation is not under control. It is not. So it doesn't seem logical to wait until October to see, they take away their choice. So if they don't raise rates now, they must raise rates in October because they can't raise rates in December. And that means that in October, whether it's a good time or a bad time, they have to raise the rates because they still can't do it in December. And they can't not do it because there's no way inflation is going to stay under control. The Fed's not stupid. They know that they know a 5% bump in the dollar is the only thing that kept inflation in check over the summer. So they lucked out. They had an excuse from July until now to not raise rates. But this meeting now is their only choice. And if they only have this choice, they're going to, I would say they're going to do it now. So I think that people are going to be very upset that they do raise rates at this meeting. Just a quarter point. I would do just, if I'm them, I'd do just a quarter point now. And I would say we'll consider at the next meeting whether or not we do it. And then it will depend on what things look like at the next meeting. But if the dollar, this is the thing, you see this intervention, and again, I talk about this a lot. It's not really the Fed's choice whether they raise rates or not, okay? It's a reaction to what other people do, other central banks do, and it's a reaction to whether or not people are buying our bonds. Because if people don't buy our bonds, the rates are going to go up whether the Fed wants them to or not. And because we must sell the bonds, we're deeply in debt. In fact, we're over $1 trillion in debt this year. We're going to be $2 trillion in debt next year now. $2 trillion in one freaking year extra debt. We spend $2 trillion more, and it's only a $6 trillion budget. So 50% of the budget is over budget. And it's never going to stop. It's never going to go away. It can't be fixed anymore. I don't know what's going to happen, frankly. I do think you should protect yourself, though. It's hard, but it's why you always have to be hedged. It's like you don't know when this is going to blow up. If it never blows up, it'll just be freaking amazing. Anyway, so quarter point in September. That way they've got the option in October, which they would not have, to see what happens and decide whether they want to raise rates or not. They're certainly not going to lower rates. So it seems to me it wouldn't make sense to pause now and force themselves into a situation, especially with the other countries are now defending their currency and trying to weaken the dollar. So other countries are trying to weaken the dollar. Weakening the dollar causes inflation here, and the Fed knows that. So if they don't raise rates here, they will look like idiots when they pause, and the rate and inflation starts to come right back up. And the Fed cannot have people lose faith in what they do. So that's my call. So we'll see what happens. We got 2 weeks. So 2 weeks from now, I say a quarter point rise based on the beige book we just read, based on other stuff we've read. And we're going to have a lot more data between now and then. We'll see what sticks, okay? So thanks everybody for coming. I'm sorry about all the technical issues, and we will do it again next week, all right? Take care.